Yeah, welcome. We'll be talking about risk management for Euro USD scalping, a step-by-step guide. Like, if you want to go into Euro USD scalping, the risk management that you have to consider before getting involved in it. So it's going to include a step-by-step guide that will guide you through without ruining your account. So essential strategies for successful currency scalping. Okay. So Um, agenda items, introduction to scalping, fundamentals of risk management, setting up for Euro USD scalping, developing a risk management plan, and monitoring and adjusting the plan. So, these are the things that we're going to be discussing through this little video. And if you are not yet familiar with what scalping is, then we're going to be introducing you to it. Then the fundamentals of risk management. Scalping is a very, very high speed trading something. So if you are not familiar with proper risk management and the fundamentals of it, then you are setting up your account for blowing. So you can just easily blow your account if you are not familiar with proper risk management. Then setting up for Euro USD scalping, developing a risk management plan and monitoring adjustment plan. So introduction to scalping, definition and basic principles. So quick trades, that's just what uh scalping means. Quick trades. Scalping involves executing quick trades that typically last just a few minutes, targeting small profit margin. So without fluff, that's what scalping means. Quick trades. So exploiting price fluctuations. These are the things, this is what we quickly want to achieve with scalping, that it will make money by the price creating differences, from the fluctuations that happen in the market. So the primary goal of scalping is to exploit minor price fluctuations in a private minor price movement, fluctuations in the market for quick gains. There are fluctuations here and there. There are times that are bigger fluctuations, and there are times that, news contributes to all these things, but economical factors and normally price don't just stay in one place. So there are price fluctuations here and there, and that's what we quickly want to capitalize on. So what is this trading strategy that we want to be using? Successful scalping require a precise trading strategy that incorporates quick decision making and risk management. So you can't just be scalping without any precision. Because if you come into the market and just look that the price is moving you quickly want to jump into it. What if it is preparing to just take liquidity and reverse? So you've got to be very, very careful. You just have to have a precise trading strategy that incorporates quick decision making and proper risk management. That's very, very essential. So these are the definitions and basic principles you have to adhere to. So what are the advantages and challenges? Consistent profits. Scalping offers a potential for consistent profit through quick trades that capitalize on small price movements. As been said, there is a consistent profit if you do it right. If you do it right, then another advantage is market volatility. Scalpers can take advantage of market volatilities to make rapid trades, maximizing profit potential in fluctuating markets. When you have fluctuations in the market, you can just quickly capitalize on the market volatility and make some money out of it in minutes. So high discipline requirement. These are the challenges because if you are not highly disciplined in the market, then you are set to blow your account. So successful scalping demand sorry for the call. So sorry for that little break. It was a business call that comes in. I forgot to put my phone on vibration. So high discipline requirements. This is part of something that is being required um by scalping. Successful scalping demands high level of discipline to execute trades efficiently and avoid emotional decision making. If you don't have your emotions in check and you are not disciplined with your strategy and rules, you're going to make a very big mistakes when it comes to scalping. So risk of overtrading, that's another challenge. that poses itself against you, because if care is not taken, you'll be over trading because the lot of opportunities will be presenting itself. Like emotional decision making can be something a very, very big challenge because if you've been losing five in a row, then you know that the next what is it called? The next trade might not be in your favor and you'll be scared. And emotional decision making can kick in. And if you are not careful by through that, you can engage yourself in overtrading because you might want to get back what you've lost in the market. And if there is no proper risk management involved, you are done. One of the biggest challenges in scalping is the risk of overtrading, which can lead to significant losses. You just have to be very, very careful when it comes to that. So, why Euro USD is popular for scalping? Number one, high liquidity. Euro USD is the most traded currency pair globally, providing ample liquidity for traders, which is essential for scalping. Is the most traded currency globally. And when we talk about liquidity, and this makes us to have a lower, thank God, lower spreads. The Euro USD pair typically features lower spreads. It's very, 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 very low. Very, very low spreads. So allows scalpers to enter and exit trades with minimal cost. I don't want to be buttressing too much on. If you are already watching this video, I believe that you have ideas, ideas of what forex trading is, what pips spread, and all these things. That we are just discussing the risk management involved in scalping. So then volatility opportunities, the inherent volatility of Euro USD make it suitable for scalpers to take advantage of small price movements. Not that you can scalp with other peers, but Euro USD is the popular one for because of all these advantages that we listed there. It has high liquidity, lower spread, and volatility opportunities. So fundamentals of risk management. Fundamentals of risk management. So funda- fundamentals of risk management. Importance of risk management in trading. This is the main something we really want to discuss. Limiting losses. Effective risk management strategies help traders limit potential losses in volatile market conditions, safeguarding their capital. This is the only hedge you have in the market. Risk management. That's your only hedge in the market. So this is the only hedge you have in the market and risk management. And if you are involving in high speed trading, you've got to be very, very you've got to be very, very precise with your risk management. So protecting profits. Risk management not only prevent losses, but also helps in securing profits, ensuring that gains are not wiped out by unexpected market movements. These are all the limiting losses, protecting profits, not that you make money and at the end of the day, you're still going to lose it back into the something. Then it helps you to stay disciplined. Maintaining, maintaining, what is it called? Maintaining discipline is crucial for traders. A solid risk management plan keeps them focused on their trading strategy without emotional interference. So if you really want to battle your psychological disadvantages, the only best way to do it is through risk management. So it helps you in staying disciplined because if you stick with proper risk management, then you automatically know that you have nothing to worry about. Just stick with your risk management, and at the end of the day, everything is going to work out the way you want it. So you understand. So common risk management strategies. So let's talk about the strategies you can use. Stop loss order. Setting stop loss order is vital to limiting potential losses and protecting trading capital. Yeah, what I personally do is set a risk reward ratio before I even enter the trade. If I didn't have the opportunity of doing that, I'm not going to be engaging in the trade because I want to have that edge always. I can allow a move to just go without me taking the moves because I really want to calculate whatever amount I'm willing to lose on any particular trade. So I always use stop loss orders. I always use it. Then position sizing. If you don't know how to calculate your stop losses, there is no loss limit. If you don't know how to calculate that, there's no way you're going to be able to know the kind of position that you're going to, I mean, the size of the position you're going to open in the market. Because if you are supposed to use 0.05 and you're using zero point 0.5, you already know that whatever movement that happens in the market is a very big blow on your account. So diversification, diversifying trades across various assets to reduce overall risk and protect against market volatility. This particular diversification really depend what I believe determine this diversification is the type of strategy that you use and how fast it is. Because if you are really engaging in what is it called in scalping, then automatically you know that you're going to stick with your peer and use a proper strategy that align with your mental condition and everything, your risk management that satisfy everything, ticks every box for you. So if you really want to diversify, then you automatically know that, okay, this is the amount I'm willing. You can just, maybe you are trying out another stuff. So you can manage your risk through this particular one. Let's move forward. Key risk metrics to monitor. So you have to monitor your maximum drawdown. You have to monitor your maximum drawdown. Maximum drawdown measures the largest drop from a peak to a true in a trader's capital. It is essential for assessing risk exposure. Normally, you are supposed to do this one before you get into, before you determine that you want to be scalping in the market. Risk to reward ratio. This is very, very crucial because this is how you turn your trading to numbers game. Because if you pick a proper risk reward ratio when you are engaging in your trade, by prosy, you automatically know how many wins you need to have in your sample size, which means you can pick 10. If I take that trades with risk reward of 1 to 3, I'm permitted to win 3. If I win 3, I'll break even and at the same time end up with profit of 18% to 20% on my capital. So you have to be very, very precise. So anything you now win above that 3 is a profit. So you've permitted yourself to even have losses because there is no way you can do away without losses. The risk reward ratio helps traders understand the potential profit versus potential loss of a trade. The variable ratio is crucial for successful trading, especially when it comes to scalping. The variable one, you can just go with 1 to 2, 1 to 3, but you must know. Pick a sample size, turn your trading into numbers game. Pick a sample size with a standard rigid risk reward ratio because that's how you get yourself something. That's how you get something out of the market. You can't say you can't lose. You will always lose, but you must have a sample size. How many times you really want to go into market, the numbers of trades you have to win. And if you don't win it, at least you've given yourself then automatically maybe your strategy is not working, then you know where to work on. If your strategy is not working or it is your risk, the way you pick your risk reward or whatever. If you are using the risk reward ratio, you will be able to pinpoint where you need to work on when it comes to your trading. So win rate indicates the percentage of profit trades out of total trades. It is a key performance indicators for trader. Just like I said, you have to be rigid with your risk reward ratio. Know how many you want to. What's your if it is 1 to 3 that you want to deal with? How many do you have to win in 10? Maybe 10 is your sample size. Personally, I pick 100. But I'm moving to the point. If it comes to what is it called? Scalping or whatever trades I'm taking. If it is scalping, it is 1 in 100. It is 100. That is my sample size. But when it comes to normal trading, I use 2%. Maybe 50 is my sample size. Then I know I have to win 10. I mean, I have to win how many? Let's say 15 to come out profitable, just 15 in 50, I've given myself enough chances if I'm using 1 to 3. And if it is 1 to 5, I know I just have to win 20 and I still come out profitable in the market. So, you must know how to calculate all these things. But yeah, I'm just bringing the risk management of Euro USD scalping to your attention. Then let's move on to setting up for Euro USD scalping. So choosing the right broker. These are the things you want to go into Euro USD scalping. A broker has a very, very something to play, a very high role to play in your trading because Euro USD The margin, I mean, what is it called? What is being offered, the spread that is being offered by a broker determines what you're going to, because it's not a zero sum, it's a zero minus game that we are playing. Even if you close at break even, broker has already made their own money. So you have to be very, now we want to just talk about setting up for Euro USD scalping. When you want to set up yourself for this scalping something, then you know that okay, but what are the things? Importance of low spread. Choosing a broker with low spread is crucial for maximizing profits while scalping in fast-paced trading environment. Because if you didn't have a low spread uh from your broker, then you automatically know that you might be losing more while you are trading with them. So you've got to be very, very fast execution speed. You are dealing with high speed something. Then low spread is very important. If you are choosing a broker must have a very low spread for Euro USD. They must be able to execute your trades fast. So fast execution speed are vital for scalping. Delays can lead to missed opportunity and losses. So reliable customer support, good customer support can help traders resolve issues quickly, ensuring smooth. These are all the things to look out for when you're choosing a broker. User-friendly platform. A user-friendly trading platform enhances the trading experience, making it easier for traders to execute their trades, their strategies efficiently. You must be able to know, I believe you are fully acquainted with what is what, and you already have a broker, but these are all the things before you go into, and it will help your risk management. Because even if you have a proper risk management and you are dealing with high spread broker, instead, if you plan for 10 trades, you might be able to only take 9 trades because they might have deducted their own money from your account. It's not a zero sum, it's a zero minus game that we are playing here. So selecting appropriate trading tools and platform. So what are the things you needed? Impact of trading platform. The choice of trading platform can greatly affect your overall trading performance and outcome. You have to be aware of that. Advanced charting tools. Look for platforms that offer advanced charting tools to help analyze the market trends efficiently. We already have trading views for that, and it helps us a lot. So technical indicators, utilizing technical indicators can enhance your ability to make informed trading decision, just like blue box, or what is it called? You can use that one to quickly calculate your risk and other stuff. So automated trading features can streamline your scalping strategy and improve efficiency. You must, if you are the type that don't know, you can get all the tools that will help you to set automatic stop loss, take profits, getting all those ones might help you. But personally, I do it manually. So optimal trading hours for Euro USD. You must know the trade the hours, not for you to go and be stuck in a ranging market during maybe break of the banks and all the stuff. Peak market hours, trading during peak market hours increases liquidity, which is essential for efficient trading in Euro USD pair. Yeah, Euro USD is a pair that is very, very volatile and liquid, has high liquidity. So we don't have much to worry about when it comes to peak marketers. And these days, there's a lot of going on around the world. Anything can happen at any time. So London and New York overlap. The overlap of London and New York trading session provide the best opportunity for Euro USD trades due to high activity. This was says it all. Then tighter spreads. Higher liquidity during peak hours leads to tighter spreads, making trading more cost effective for trader. During this period, we have tight spreads. So let's move on to developing a risk management plan. What are the things that we need to understand? Defining risk tolerance and objective. You've got to understand risk. What we are dealing with is risk management. Risk management, risk management. We're not talking about strategy this time around. We're not talking about psychology, or neither talking about gathering experience. We're talking about purely risk management and defining risk tolerance and objective. Understanding risk tolerance. Defining your risk tolerance is essential for determining how much capital you are comfortable risking on trades. This is very, very important, because any money you are bringing into trading, you must automatically know that you've lost that money. Whatever happens to the money, you should be able to accept it. If it is profit, fine. If it is losses, you must be able to accept it as well. So you must know your risk tolerance. Is very, very important and crucial. Setting trading objective, establishing clear trading objectives helps provide direction and maintain focus throughout the trading process. Set your trading objective very, very clear. Understand your risk tolerance, and all these things are what is going to help you and put you in the proper and the right mindset. When you are trading, psychology matters, but risk management is what helps psychology. If you blow your account today, there's nothing to offer for you tomorrow to maintain your psychology or wherever. You've already blown your account and you're out of the market. So determining position size and leverage, importance of position size, calculating position size helps manage risk by ensuring no single trade heavily impacts your account balance. If you are good with risk reward ratio, you will understand this. Just study that more, know what you are doing, and risk tolerance assessment. Understanding risk tolerance is essential for determining how much capital to allocate per trade and safeguarding against excessive loss. All these things comes with risk reward ratio. Leverage management. Effective leverage management minimizes potential losses while allowing for greater capital efficiency in trading strategies. All these things works and in Nana, you must pay a very, very close attention to all of them. Implementing stop loss and take profit strategies. If you did, the secret to all these things is risk reward ratio. Because if you pick your risk reward ratio, you know how much you are risking per trade and know how much you are expecting. So automatically by setting a very proper risk reward ratio, you know how many, yeah, if you pick a sample size, then you know what you have to win, you know what you have to lose. Then automatically you know you will bang yourself something good. So stop loss orders are essential tools for protecting against significant losses in trading by automatically selling a security at a predetermined price. Take profit orders allow traders to lock in profits by automatically selling a security once it reaches a specified price level. All these things are explaining risk reward ratio. Because if you do that properly, all these ones are hint at discipline trader. We've been talking about back and forth with discipline, risk management, and other stuff. If you are disciplined with your risk management, automatically your psychology will be balanced. Implementing trading, implementing stop loss and take profit strategies is vital to maintaining discipline and maintaining risk in trading. The same thing we've been talking about, monitoring and adjusting the plan. So regular review and adaptation. Um, Before we go into it, remember risk reward ratio and picking your sample size. Within your sample size, how many did I win in my sample size? If I win three, what's my risk reward ratio? Did I come out profitable? All these things we help you to review appropriately. So let's regular reviews and adaptation. When you review or something, you adapt quickly. Importance of regular review. Regular reviewing trading performance allow you to identify strengths and weaknesses, enhancing overall effectiveness. So this helps you a lot. Risk management strategies. Evaluating the effectiveness of your risk management strategies ensure you protect your investment during market fluctuations. Adapting to market changes. Adapting your trading plans in response to a changing market condition is crucial for long-term success in trading. So handling unexpected market movement. We use proper risk management, and sometimes there is what is it called? A very gap. If there is gap in market, something happened this week. I left my trade on Friday, opening in Monday. During the weekend, Friday to Sunday. Then what is it called? Um, yeah, United States drug bomb on Iran, and at the same time, that causes a very big gap in the market, and that led to what is it called? It led to a very big gap, and some of my orders were taken out, and it causes something. But because of proper risk management in the market, we were able to cover it. We're able to kind of like, you were able to handle it and absorb it without any slight provocation from my hand. Because, I always use my proper risk management. So handling unexpected market moves, impact of market movement, unexpected market movements can create a significant risk for traders and impact investment strategies. So understanding these impacts is crucial for effective trading. You must be very, very aware of all these things. Contingency plans. What if you blow our account? Do you have backup? It is important to have contingency plans in place to mitigate risk during unexpected market shift. Adjusting strategies can help manage losses. Adjusting stop loss levels can help protect investment during sudden market changes. This strategy is essential for risk management. Once again, risk reward ratio. Be good with it, and you're going to have something. So using performance metrics for improvement, identifying strength, performance metrics reveal the strength of your trading strategy, helping you recognize what works best. If you just well, the best way to do it is just to pick a sample size. Let's assume, okay, my risk reward ratio is 1 to 2 and I'm picking a sample size of 10. And if you go into the market with risk reward of 1 to 2, and you permit and give yourself, you must be able to determine what to win and what to lose. And if you to come out profitable, if you are able to do that appropriately, then automatically if your objectives are not met and you try it the first time, the second time, you are gathering your metrics. And if you'll be able to identify your strength through that, then identifying strengths, performance metrics reveal the strength of your trading strategy, helping you to recognize what works best. If you keep track of all those things, if you keep track of what is happening here and there, then you'll be able to know and understand what you are dealing with. If you don't keep this record, there is no way you'll be able to do what to handle all these things in the market. So now, recognizing weaknesses. By analyzing performance data, you can pinpoint weaknesses in your trading strategy that needs improvement. Then you'll be able to improve them. Informed adjustments. Utilize insights from performance metrics to make informed adjustments to enhance your trading outcomes. So use all your performance metrics, picking a sample size, then you can automatically know where to work on. So what are the conclusion? Importance of risk management. Effective risk management is essential for minimizing losses and maximizing profits when trading your Euro USD in forex market. So you've got to be very, very, important. So it is essential for minimizing and maximizing your profit when scalping, it helps a lot. Understanding scalping principles, traders should have a strong grasp of scalping principles to make informed decision and execute trades efficiently. Continuous performance, regularly monitoring trading performance allow traders to adjust their strategies and improve their trading outcome over time. So I believe with this little something, you are able to know what to do when you are scalping Euro USD and you know how to manage your risk, what to do, how to calculate your risk and all those stuff. So that at least you'll be able to do what? Come out profitable trading, scalping Euro USD. Thank you very much. We've come to the end of the video. Have a profitable day and week ahead.